We welcome Bloomberg News bank reporter who covers JPMorgan, Don Kopecki. Now, Don, I know we're going to get into things like mortgages and credit cards and how important the stress tests were at looking at those particular bank assets, but let's talk about JPMorgan for a minute, because you and I both know that the talk of the street yesterday afternoon and today is how on earth JPMorgan got out in front of the Fed, releasing or at least announcing that it had passed the stress test and that it was going to return capital to shareholders with the buyback and the dividend hike at 3:04 yesterday afternoon.
Yeah, well, what happened was the Fed informed the banks around noon yesterday that it was going to go out 2 days early with its news, and that was because the Fed was worried that some information was starting to leak to the press and that the Fed had inadvertently released some information. And so the Fed moved its date up by 2 days. Somewhere in there was a miscommunication, is how the Fed is characterizing it, between the Fed and JPMorgan. And JPMorgan took it as a green light to go ahead with their announcement. Jamie Dimon wanted to be first. Last year, he wanted to be first out the gate in announcing his dividend, but he wasn't. He was beat to the punch by one of the regional banks. I think it may have been U.S. Bancorp or BB&T, but one of the regional banks beat JPMorgan, and by God, he was not going to let that happen this year, and he didn't.
And this really underscores that testy relationship, right? The very fine line that any bank has to walk, balancing the relationship that it has with its regulator, in this case the Fed, against the interests of shareholders, because every shareholder, everybody who owns a share of JPMorgan stock, love that headline.
They're very happy today. They're very happy today. The $15 billion in buybacks is a little bit deceiving, though, however, because it also includes employee share repurchases, and Charles Peabody estimates that could be $5.5 billion. And it also includes $3 billion that's being pushed ahead into 2013. So it's not as big as that big number, that big pop you got in the headlines. But investors were very happy. Fed examiners not so happy. It is suffice to say, whatever happened behind the scenes, it was a colossal screw up on someone's part. The Fed is saying officially that it's not JPMorgan's fault, but I know that staff and examiners at the Fed, they are completely unhappy with JP.
Don, while we have a little time left, let's talk about the stress test itself, because you got out ahead of this announcement from the Fed a couple of days ago with a very prescient story pointing out that for the banks that weren't going to get approval, it was going to have to do with mortgages and credit cards, and that's more or less what we found out, right?
Consumer loans, mortgages specifically, and credit cards were the biggest area of losses that the Fed found when it stressed these banks against a severe economic scenario. It was, mortgages. They've got a chart here, but it was first lien, credit cards, and second liens and other consumer debt were the biggest share of losses, bigger than trading losses combined, bigger than commercial losses. And so that is really an area that the Fed is super concerned about. And it's because, as we discussed, consumers are at a very fragile point right now. People are starting to do okay. Delinquencies are going down, but unemployment's still high. And if there's anything that pushes, those people on the margins, or even people who aren't on the margins over the edge, they've depleted their savings to this point to stay where they are, to keep their head above water. And if there's anything else that pushes them over the edge, home lending delinquencies, credit card losses are going to spike.
Don, thanks very much for coming back to the Inside Track. Don Kopecki with some insights for us on the Fed stress test.